Imagine this. Today is July 4th, 2026. Everyone is asking the same question. Is this still the beginning of a historic bull market, or are we witnessing the final chapter before everything changes? History suggests that by the time the average investor starts asking this question, smart money has already moved on to the next one. They aren't asking where the top is. They're asking how much risk is left compared to how much reward remains. That single shift in thinking has separated great investors from everyone else for decades. So before you make your next investment decision, there's something you need to see. Because the biggest mistake investors make isn't buying too early. It isn't selling too late. It's believing they'll somehow recognize the exact top when it arrives. They won't. Almost nobody does. And history proves it every single cycle. Think back to previous market booms. At every major peak, confidence reached its highest level just before uncertainty returned. Headlines were overwhelmingly positive. Analysts competed to raise their price targets. Retail investors became convinced that every dip was another buying opportunity. Then, almost without warning, the narrative changed. That's why experienced investors spend less time predicting prices and more time watching what the market is actually doing beneath the surface. The first thing they watch is liquidity. Where is money flowing? Are investors still aggressively buying risk assets, or is capital quietly rotating towards safer positions? Those shifts rarely make front-page news, but they often reveal changing sentiment long before prices do. The second thing they watch is risk appetite. Late in every cycle, leverage increases, speculation becomes normal, and disciplined investing starts looking boring. That's usually when experienced investors become even more disciplined, not because they know a crash is coming, but because they understand that risk grows when everyone believes risk has disappeared. Here's one of the biggest myths in investing. Successful investors do not consistently sell at the exact top. In reality, many of them don't even try. They know timing perfection is nearly impossible. Instead, they manage probabilities. As markets become more expensive and uncertainty increases, they often reduce exposure gradually, lock in part of their gains, and prepare for multiple possible outcomes. Their goal isn't to maximize every last dollar. Their goal is to avoid catastrophic mistakes. That mindset is one of the biggest differences between professional investors and emotional investors. Right now, the market is divided into two competing narratives. One side believes the strongest gains are already behind us. They point to elevated valuations, higher interest rates, and slowing earnings growth as reasons for caution. The other side believes another wave of optimism, driven by artificial intelligence, innovation, and improving economic conditions, could push markets even higher before this cycle finally ends. Both arguments are reasonable. Both could be partially right. And that's exactly why experienced investors avoid making all-or-nothing decisions. They prepare for both possibilities instead of betting everything on one prediction. So what should individual investors do? Start by asking yourself one uncomfortable question. If the market dropped 20% tomorrow, would your portfolio still reflect your long-term plan? Or would fear force you into making emotional decisions? If the answer makes you uncomfortable, that's valuable information. Next, remember that diversification isn't exciting, but it has survived every market cycle for a reason. Rebalancing your portfolio regularly isn't about predicting the future. It's about preventing one successful investment from quietly becoming your biggest source of risk. And don't underestimate the value of liquidity. Cash isn't always a missed opportunity. Sometimes it's the flexibility that allows investors to act when everyone else is trapped by fear. Every major market cycle teaches the same lesson. Market tops aren't announced. They don't arrive with flashing warning signs. They emerge when confidence becomes certainty, when caution disappears, and when investors stop asking what could go wrong. That's why the investors who survive decade after decade aren't necessarily the smartest. They're the ones who stay disciplined when everyone else becomes emotional. In the end, investing has never been about finding the perfect trade. It's about making consistently good decisions over a very long period of time. Because one spectacular year won't build lasting wealth, but avoiding one devastating mistake just might. So here's my question for you. If this market keeps climbing, what would finally convince you that it's time to become more defensive? And if the next correction begins tomorrow, do you already have a plan? Or will you be making decisions in the middle of the storm? Let me know your thoughts in the comments. And if you enjoy thoughtful market analysis based on logic instead of hype, subscribe now, because the months ahead may become some of the most important of this entire market cycle.